Hello everyone, Steve Lentz here with Discover Options. Welcome to this presentation of several market reports for advanced options traders. This is for Friday, September 1st, getting ready after Labor Day for Tuesday, September 5th. Tuesday, September 5th. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So we have the SPX Condor Butterfly Timing Report. For those of you that like to trade from a market neutral perspective, you can make money no matter which way the market goes. We have the SPX Bull Put Spread Timing Report that answers the question, is now a good time to put on a bull put spread in the SPX, a standard deviation out in the puts, maybe 30 days out in time, something like that. The S&P 500 Directional Likelihood Report answers the question based upon past occurrences of the current market condition, where is the market likely to go? All right, so without further ado, want to ask you to subscribe to our channel first. Click on the subscribe button, and love to have you get notices whenever we come out with future videos. And also we have an ebook, Simple Steps to Options Trading Success. Just click the link, give us the data, and we'll send you that ebook. It's co-authored by myself and Jim Graham. The current market condition, for purposes of all three of these reports, is defined by price action, trend, and then the stochastic indicator. So in terms of price action, we have had we've had multiple up days, upswings with higher highs and higher lows. Thursday was an upswing, and Friday was an upswing bar. This happened while price is above the 50-day simple moving average, and the 15-3 stochastic is between 60 and 100, located above its percent D, the 3-day simple moving average of percent K. So all of that makes for a market condition that's happened quite often. Non-consecutive occurrences total about right around 300. Including consecutive occurrences, you're well over 500 occurrences since January of 2000. Okay, so we have a nice population to deal with here. Let's go to the first report, the Condor Butterfly Timing Report, for those of you that trade butters and Condor campaigns. So, since January of 2000, as I mentioned, we've had 4,461 daily closes of the SPX, just simply, in looking for a benchmark here for over 4,460 closes. Now, of those 4,461 closes, 65.7% have been favorable bars for selling premium where the actual subsequent 21-bar movement was less than the movement implied by the SIBO skew-adjusted VIX. Okay, so again, 65.7% have been favorable bars for selling option premium, and we define that by comparing the actual movement to the movement implied by the VIX. Now, also during that time, our current condition, as I said, occurred 549 times, including consecutive occurrences. Now, of those, 71.4% of the bars were similarly favorable for selling option premium. 71.4, that's higher than the benchmark of 65.7, to the tune that we calculate a selling edge now of roughly 5.7%. 5.7%, where the subsequent movement is less than that's implied by the option prices themselves. So we're selling fatter premium than what the market actually, we're selling fatter premium, implying a bigger move than what actually takes place, which is good. As option premium sellers, condors and butterflies, that's a good thing. So statistically, it's more likely than usual that the current market condition will end up being favorable for market neutral option premium selling. Okay, that's the Condor Butterfly Report. Let's go, for those of you that lean your strategies bullish and you sell premium in the puts, maybe out of the money, one standard deviation away, 30 days, or maybe you like that information and can tee off on other strategies regarding it. So, since January 2000, 4,461 closes. The SPX, now of those, 83% were favorable bars for selling put premium a standard deviation away 30 days out. Premium and favorable bars, meaning that short strike was not hit within 21 trading bars. Okay, and so and that's 80. So you could flip a coin multiple times, and 83% of the time, price does not go down and strike that, hit that short strike there. Now, also during that time, our current market condition occurred 549 times. Of those 549, okay, of those occurrences, 86.2% of the bars were similarly favorable, where the subsequent movement to the downside, it didn't go down and hit that short put 86.2% of the time, or at least to that level, standard deviation away 30 days out. So 86.2 is higher than the 83. We calculate an edge of 3.2% here, 3.2%. So statistically, it's slightly more likely than usual that Friday's bar will end up being favorable, or more favorable, or it will, how do you say it? It's more likely than normal it will end up being favorable for selling put premium a standard deviation away out of the money. Okay? So, good stuff, good times for the premium sellers. Now, does it mean you're going to definitely make money? No, it just means based upon the previous incidences of our current market condition, it's more likely that you will, trading those strategies. Now, the market likelihood report, answering the question, based upon past occurrences of our current market condition, where is the market likely to go? Okay? And to answer that, where is it likely to go, we need to look at price distribution. Price distribution, and we do that by looking at distribution bands. I use 6 of them, 3 above the close and 3 underneath the close, set 5, 10, and 15 days, 1 standard deviation away on the upside, and 5, 10, and 15 days, 1 standard deviation away underneath the close. Okay? Now, let's just take a look at an example here. So here are 5-day bands, 1 set above the close, 1 set underneath the close, just as a quick example. So this is a 5-day band. Here's a 5-day band set underneath. Notice that the upside band is closer to the close than the downside band, which is farther away. That's because I'm using the skew-adjusted VIX. The skew-adjusted VIX. I'm letting the options market, determine the location of these bands. And the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts in the SPX. So hence, the upside band is going to be a little bit closer than the downside. And so the question is over the next 5 days, will price hit the upside band or the downside band, or wobble around and hit neither of them? So what we've done is we've gone back over those, over 4,400 closes, and we've kept statistics on what price has done. And we've kept statistics so that we can get at least a feel for the distribution of price in the long term. All right, so here are the, let's see, these are the 10-day bands, and then here are the 15-day bands. We keep statistics on all 6 of these bands. And when you take a look at the statistics, we go up here to right here. Over the course of 4,461 occurrences, the upper 5-day band was struck 21.3% of the time. The upper 10-day band, 15.8. The upper 15, 14.7. On the downside, 16.7, 16.9, 19.6. Now, we have 300 non-consecutive occurrences of our current market condition occurring in the past. Of those 300, not even 10% struck the upper 5-day band, 9.7% versus 21.3. It struck of these 300, a much lower percentage struck the upper 5-day band than the benchmark from the whole population of 4,461. Okay, so it failed to reach that 5-day band quite often, over 90% of the time. Same thing with the upper 10-day band, 8.7% versus 15.8. Big difference here. The upper 15-day band, again, not even 10% hit the upper 15-day band for a big difference from the benchmark. On the downside, the lower 5-day band was struck 11.3. The lower 10 was hit 14.7 and 13.7. All 6 of these bands were struck less often than the benchmark. So this is a picture of lower market volatility. Lower market volatility. Does it mean that the market will be definitely less volatile? Well, no. You can see that it actually has hit the bands, roughly 10, 12% of the time. It'll hit one of those 6 bands. All right. So we can never say never, statistically going back, but certainly it's less likely to. We did divvy these up so that if price exceeds Friday's high, okay, that in the past has happened 186 times. We have a similar level of lower occurrences of the bands getting struck. Way out here on the lower 15, it did hit it about the same amount of times, percentage-wise. And then if price exceeds Friday's low, we have similarly all 6 bands are getting struck less often. So again, this is a picture of lower market volatility is more likely in the future based upon past incidences of our current market condition. Okie dokie. All right, I hope that information helps you advanced options traders. I'm Steve Lenz with Discover Options. Thank you for joining us. We'll see you next time. Bye-bye.